Hi everyone, I hope you're well. I'm at Jackie's today with terrible lighting, so apologies for that. But yesterday I said I was going to pop on and do a video about stress tests and the impact that the increase in base rates having on those stress tests. So yeah, life's chaos, work's chaos. So I'm here today talking about that. So a bit of background about stress testing. So the whole idea of stress testing is to make sure that the mortgage payment that you are taking out now is going to work for you long term and is a viable property with viable rental income long term. So what happens is the lender, if you're borrowing using a 5-year fixed rate, the lender will use what we call the pay rate, so the actual 5-year fixed rate. If you're borrowing on a fixed rate or a tracker rate that's any less than 5 years, then they will stress it at an artificially higher interest rate. So that used to be about 5.5% because that's what was seen to be the likelihood of where it would kind of end up as a sort of worst case scenario. Obviously things have changed, we'll come back to that. So what they do is they take your pay rate or your artificially higher stressed rate and your rental payments have got to cover your mortgage payment by a certain percentage of that. So if it's a standard buy-to-let property and you own that property in a limited company, your rental's got to cover the mortgage payment by 125%. If it's a standard buy-to-let property and you own it in an individual name, then it can range between 145 to 165%. Depends on the lender, also depends on your personal tax situation. If you're a lower rate taxpayer or basic rate taxpayer, it would be 145 most of the time. If you're a higher rate taxpayer, it would sit at 165%. For more complicated properties, and sometimes the percentage is higher. So for example, for HMOs, it does depend on lender, but sometimes it can sit at 140%. For large HMOs, sometimes it can be 160. And if it's in a personally owned large HMO, there are lenders that will stress it up to 195%. So it's lender dependent as well as your personal circumstances and the type of property. So there are variations. The minimum though will always be 125%, and that is limited company owned buy-to-lets, small HMOs. So what's happening now, as the base rate is increasing, then the stress rate is obviously also increasing. If you had a 5-year fixed rate previously at 4.4, for example, you could stress it at 4.4. The equivalent rate is probably pushing 7% now, so it's then being stressed at 7. And again, if you've got personally owned property, you're a higher rate taxpayer, it was more complicated property, then that stress rate is much bigger percentage. It's having a much greater impact. I was pricing up something the other day for a client. He had a single let property in Oldham near Manchester, personally owned. He had a property that was worth roughly 250. The rental income was £1,100 per month, and we couldn't get to 75%. So what we're seeing now is that if particularly where you've got single let properties, because your rental is generally lower, that there are situations where we cannot get to 75% borrowing because the stress rate, the stress calculation doesn't allow you to do that. So it's increasingly important for you to think, what are interest rates going to be? And this is really important when you're looking to buy property and refurb it to then refinance, because you're basing it on predictions of what might be around in 6, 9, 12 months even. So really think about what that worst case scenario is. If interest rates end up at 9%, there are buy-to-let products out there at 9% at the moment, so it's not unreasonable. Is that still going to work? And not only is it going to work in terms of, is it profitable, but is it going to work in terms of, are you going to be able to pull out 75% of your new value? Because I assume you might have investors that you want to pay back, you've got bridging you need to pay back, you want to recycle that cash and go again. So it's really, really important. There are ways that you are going to be able to maximise how much you can borrow. You may have picked up limited company lending has a lower stress test. That's because generally you're paying less tax, so therefore there are less outgoings. So that's the methodology behind it. Obviously speak to your accountant. I'm not an accountant, I'm not a tax advisor, so I can't give you best advice in terms of what's good for you and your income, but I can tell you that if there is a limit on the income that you're getting, you will be able to borrow more in a limited company than you will be in a personal name. If you increase your rental, then you will be able to borrow more. Now, I don't mean that in terms of how much you're getting, because it's always, as you know, if you've spoken to me before, based on market rent. The valuer will give us market rent, and that is what the lender will use. If you are commanding 20-30% above market rent, it doesn't matter. That's not what we're going to use. Theory being, normally that's when you've just refurbished a property, it's looking beautiful, but if you don't maintain that, or even if you do maintain that, in 2 or 3 years' time, it's no longer brand new. So you're not going to be commanding that extra rental income. So always use market rent. If you want to increase your income, you need to be thinking about HMOs, which I know are coming with their own challenges in terms of energy prices, but something to think about. Students less likely to be all inclusive, no council tax. Holiday lets, blocks of flats. If you're looking at sort of 2 or 3 flats in a block, quite often the values are lower, the rental income is higher, and also the location where you're looking at properties. In the south east of England, it's going to become more and more difficult to get to 75%, and that area is going to spread the more that interest rates go up. So where you've got much higher yielding property, i.e. low house prices, relatively higher rental, that's where you're going to be able to have more chance of getting to that 75% figure. So you may end up needing to do more smaller value properties, potentially not then getting the capital growth, but you'll be able to pull your money back out and go again. So it's worth just sort of really thinking about your strategy. I think everyone is doing that at the moment, really thinking it through. Is it profitable? Is it working long term? Am I able to make that profit out of it? Is it going to continue to allow me to do the things that I want to do? Obviously, if you've got any questions, then give me a call. I'm happy to run through any examples that you've got, see if it works. I hope that's been useful. Really think about it. I'm not saying things don't work. I'm not saying not to buy property. With uncertainty, there absolutely is opportunities, but you just need to price it. Just be really, really careful about your profit margins and your rental. Hope that helps. Speak to you later.